SEBI launched a new category of mutual funds for wealthy individuals who want to take on a little bit more risk than ordinary mutual funds. So this category, or SIF, Specialized Investment Fund, is of a minimum ticket size of 10 lakhs. And this is across SIF. So you can have, let's say, 3 lakhs in one SIF, 3 lakhs in another SIF, and 4 lakhs in a third SIF. You can also potentially do SIPs, or systematic investment plans, into SIF, but your minimum investment across SIF cannot fall below 10 lakhs. Of course, if it falls below 10 lakhs because the NAV has gone down, that's okay, but yourself you cannot redeem it in such a way that it falls below 10 lakhs. Second thing to note is that these rules will go into effect on 1st April 2025, and it is only thereafter that these products will be gradually approved and launched. So it's not coming in a hurry. The third interesting part about them is that they have limited withdrawal. Now, normally in a mutual fund, there is daily withdrawal and daily investment. On any business day, you can invest and redeem money from mutual funds. In case of SIF, SEBI has allowed the fund house to specify the frequency of withdrawal. It can be weekly, monthly, quarterly, or even annual. And the reason for this is because this is a high risk category, and if you allow daily withdrawals, it can create a problem, it can create a liquidity issue. So they have allowed the mutual funds to specify the frequency of withdrawal. Now, the most distinctive thing about this category is the use of derivatives. SEBI has allowed them a strong use of derivatives and even something called a naked short position up to 25% of the corpus. What does this mean? So when you are short something, it means you have sold it. You're going to benefit if the price comes down. And a naked short means that you don't own the underlying asset. You have just sold it on a speculative ground. So up to 25% of the corpus of the SIF, SEBI has allowed for naked shorts also. Now, the question is, how is an SIF going to be taxed? Well, the answer is the same as any mutual fund. So if the SIF has more than 65% in equity, it will be taxed at short-term capital gains 20%, long-term capital gains 12.5%. If it has equity between 35% and 65%, then after 2 years, it will be taxed at long-term capital gains 12.5%, short-term capital gains slab rate, if you redeem before 2 years. And of course, if it has more than 65% in debt, then it will always be taxed at slab rate. So the same taxation for different categories of mutual funds will apply to SIF. And that is the beauty of this product, because essentially what it does is it challenges category 3 alternative investment funds, or AIFs. These funds are allowed these kind of strategies already, long short strategies, use of derivatives. But unfortunately, in the AIF wrapper, they have to deduct tax at slab rate for trading income. So if they do F&O transactions, they have to deduct tax at as high as 39%. It's not tax efficient. And this is something that the SIF will actually challenge, might take market share from category 3 AIFs. And of course, category 3 AIFs are only open for a minimum ticket size of 1 crore, whereas SIF is bringing it down to 10 lakhs. A lot of debate has happened about whether SIF is going to do away with PMS or challenge PMS. This was the initial speculation. Now, this is not going to happen, because the typical PMS is long only. It runs a concentrated portfolio, more concentrated than the ordinary mutual fund. And SIF has not relaxed the concentration norms for the schemes inside SIF. So for example, the 10% limit on investing in a single company, that very much applies to SIF also, whereas PMS doesn't have that. So PMS can continue to run as it is. There is no big challenge to PMS per se. Now, in order to distribute SIFs, mutual fund distributors have to give another exam, the NISM derivatives exam. They cannot just get up and distribute an SIF. Now, what kind of products can come under this SIF umbrella? So, there are 3 categories of SIF. There is equity SIFs, there are debt SIFs, and there are hybrid SIFs. And as Kirtan Shah put it in the LinkedIn post, essentially an equity SIF in the large cap category is a standard large cap fund, but with use of derivatives, additional use of derivatives, and 25% naked short. And the other category of equity, SIF, which is outside the top 100 stocks, is a mid and small cap SIF, again allowed to use 25% naked short. So this is broadly true, but the interesting thing about the use of derivatives is that you can have funds that, for example, adopt the structured product route. So if you remember structured products, these are essentially products that offered payouts depending on when the market went, and there used to be a guarantee. So typical construction would be that if you invest in this product for 3 years, then they would guarantee your capital back if the market gave a negative return even after 3 years. If the market went up, let's say one time, it went up by 100%, then you would get maybe a 50% return, and if it went up by 200%, then you would get a 250% return. So usually structured products were constructed in a way that to give you that assurance of getting your capital back, but giving you a larger upside if the market rallied massively. This is one example. There are many ways in which structured products can be constructed. So in the old days, structured products were packaged into MLDs or market linked debentures. There was an issuer guaranteeing you the return of capital. So this is not needed now in an SIF. You can have a structured product without the need for an issuer or an MLD guarantee. Another kind of fund that can crop up in the SIF structure is an absolute return fund. So what does that mean? Most mutual funds are tied to the market. They might fall more than the market, high beta, or less than the market. They might outperform a little bit with alpha, but they are more or less tied to the market. If there is a down market, mutual funds go down. Now, an absolute return fund tries to give you a return regardless of market conditions, and it does this, for example, by shorting some stocks and going long other stocks. So it kind of becomes market neutral. You're not affected by the overall movement of the market, you're hedged. So this is the kind of fund that might show up in the SIF structure. Or you can have debt funds which use interest rate futures and options to hedge debt. So in a typical debt mutual fund, if interest rates go up, then the debt fund NAV falls. But in a debt SIF, if they're using derivatives, maybe they'll be able to shield investors from that kind of market effect. Now, the most interesting thing, and it's a little bit debated, is options and leverage. So the SEBI rules about SIF say that 20% of the corpus can be invested in options, and if you buy options, if the SIF is buying calls or puts, then that 20% limit is on the premium. It's not on the notional amount. Why is this interesting? Why is this significant? Because let's say that you have an SIF with 100 crore corpus. 80 crores is put into stocks, into equities. 20 crores is put into, let's say, call options, right? Now, that 20 crore worth of premium will give you exposure to maybe another 100 crore worth of notional or underlying. So effectively, it gives you a sort of 2x exposure of the capital that you have put in. Now, is this what SEBI intends with the options provision? There's a bit of a debate, there's a bit of a disagreement among lawyers and experts, but this is an interesting possibility that might arise from an SIF. Now, do you need all this complication, all of these options and derivatives and all of the rules that I just went through? For most people, the answer is no. A simple flexi-cap fund, a simple hybrid fund or multi-asset will do the job. You don't have to do a PhD in finance and get into all of this. But for those who are sort of attracted by high risk, who are taking a punt on the market, who want a tax efficient structure to do it well, an SIF presents an interesting opportunity.